It's 2008, the economy is falling apart, Lehman Brothers just collapsed, people are losing their jobs, their homes, their entire life savings. The stock market is in a free fall, and the headlines are screaming, this is the next Great Depression. Every investor is panicking. But if you had $10,000 in cash at that very moment, would you have had the guts to put it into the market? Realistically, most people would not. When the market crashes, fear takes over. But what if, instead of running, you had invested right at the worst moment possible? What if you took that same $10,000 and bought the S&P 500 at its lowest point? Here's what would have happened. On March 9, 2009, the absolute rock bottom of the Great Recession, the SPY ETF, which mirrors the S&P 500, was trading at a jaw-dropping $67. If you had the courage to throw in $10,000 into the market at that exact moment, you would have purchased 147 shares. Fast forward to February 25, and the S&P 500 is right now sitting at $606 per share. The $10,000 investment would have ballooned to $89,000, an 800% return. And that's without even accounting for dividends. And yet, here's where most people say, yeah, but that was just one time, right? Okay, let's put that theory to test. Let's go back in time and examine the worst stock market crashes in history. Not just to see how bad things got, but to prove that even in the darkest moments, there were golden opportunities for those who stayed the course. The dot-com bubble was a disaster. The S&P 500 collapsed 49% from its peak as overhyped tech stocks crumbled. If you had invested $10,000 at the absolute bottom, when the S&P 500 was around $77, you would have snagged 129 shares. Where would you be today? Sitting on $78,000. That's a 700% return despite investing at the worst possible time. Let's talk about a recent crash, the COVID crash of 2020. Now, this one hits close to home because I witnessed it firsthand, and honestly, it feels like yesterday because it's just hard to believe that it's been 5 years since the COVID crash of 2020. The headlines were pure chaos. March 9, 2020, the Dow Jones was down 2,000 points. That was a 7% drop at the time. March 12, 2020, another record-breaking plunge. The Dow Jones was down 2,300 points. That was a 9.99% drop. Then March 16, 2020, an absolute freefall. The Dow nosedived almost 3,000 points, and in percentage, losing a staggering 12.9% in a single day. The collapse was so extreme that the New York Stock Exchange had to halt trading multiple times just to stop the bleeding. Personally, it was the first crash that I had witnessed. But let's talk numbers. At its lowest point, the SPY ETF hit around $220. If you had invested $10,000 at that exact moment, you would have walked away with 45 shares. And today, those shares would be worth $27,000, which is a 175% return. I could keep going and keep pulling numbers. There was that mini crash in 1989, the Black Monday in 1987, the oil crisis in 1973, and so on. You see the pattern here, right? A 30 to 40% drop in your portfolio is painful. But most investors don't realize that these crashes are temporary and they're always followed by long-term gains. The dot-com crash, 3 years of brutal losses and then 5 years of gains. The 2008 Great Recession, 1 year of absolute devastation and then record-breaking bull run. The COVID crash, well, that one barely lasted for a month. The markets roared back to all-time highs. Since 1929, there have been plenty of major stock market crashes, and every single time the market did not just recover, it soared to all-time highs. History has proven that downturns are temporary, and the long-term trajectory of the market is usually upwards. Even if you had the absolute worst timing and invested right before a crash, you still made money in the long run. But here's where most investors make a critical mistake. It's not just about surviving the crash, it's about staying invested through the recovery. If you sell out when fear is at its peak, you almost always miss the recovery. And missing just a handful of market's biggest days can wipe out your entire returns. Let's say you invested $10,000 in the S&P 500 on January 2nd, 2000 and left it alone for 20 years. If you stayed fully invested, your money would have grown to $42,000. If you missed 10 best days of the market, well, your final balance drops to $19,000. If you missed 20 of the best days, you would barely have $11,000. That's 5,000 trading days, and missing just 20 of the best ones would have cost you a majority of your gains. The market's biggest up days often happen right after the biggest crashes. If you sell out, you almost always miss the recovery. Then let's talk about the sequence of returns risk. The risk that a market downturn will hit right before you start withdrawing your money. If your portfolio drops 30 to 40% early in retirement when you start to sell your stocks to cover for your living expenses, you could drain your savings much faster than expected. But this risk can be managed with the right strategy, and you don't need expensive financial products like whole life insurance to do this. This fear is often exploited by whole life insurance salesmen who cherry pick market crashes to scare retirees into locking their money into expensive policies. They make it seem like every retiree loses everything in a crash. But the reality is, with proper planning, like the bucket strategy, you can minimize this risk. Instead of relying on one big investment account, the bucket strategy divides your savings into 3 separate categories. The short-term bucket, which holds cash and bonds for immediate needs, could hold 2 to 3 years worth of living expenses in cash, money market funds, or short-term bonds. If the market does crash, you have liquid assets to cover expenses without selling stocks at a loss. Then you have the medium-term bucket, which could hold longer-term bonds, some income funds, or conservative funds that would provide growth while minimizing risk. It can be used to refill the short-term bucket when the markets are strong. Then finally, you have the long-term bucket, which is your most aggressive bucket, invested in stocks, index funds, and growth assets to protect against inflation and maximize the long-term gains. And because you won't need this money for 5 to 10 years, this bucket has time to recover when the market crashes. So with this bucket approach and a little bit of planning, you can sleep easy. If you're 35 years old today and planning to retire at 65, that means that you have a 30-year investing horizon. If you look at every 30-year period in the stock market history, despite wars, recessions, and financial crisis, the market has never delivered a negative return. Not once. Even if you had invested right before the Great Depression, held through World War II, the stagflation of the 70s, and the dot-com crash, your money still grew significantly. You might be wondering, how is it that the market always recovers? A big part of it is inflation. Over time, the cost of goods, wages, and corporate revenues increase. This pushes stock prices up. If you compare the stock market to a grocery store, you'll see the same trend. Prices keep rising. A gallon of milk used to cost $1 in the 1970s. Today, it's closer to $5. Stocks work the same way because they represent a real business that increases in value over time. At the time of recording this video, the concern that people have today is that the stock market is at an all-time high and valuations are through the roof. Is it really the right time to invest? You know what? 95% of the time, the market is either at an all-time high or within 10% of one. If you waited for a dip every time, you would almost never invest. Take 2013, for example. The market had already recovered from the financial crisis, and many people thought it was too late to invest. But from 2013 to 2025, the S&P 500 has more than tripled. The proof is in front of you on this chart. Waiting for the perfect moment is the perfect excuse to do nothing. Buffett has famously said that be fearful when others are greedy and greedy when others are fearful. But it's human nature to do the exact opposite. We get excited when stocks are soaring and terrified when they're crashing. But if you flip that script and continue to invest when fear is at its peak, history shows that you will be rewarded every single time. I was reading a comment the other day from a gentleman where he was comparing the Japanese stock market to the S&P 500. And for those who don't know, the Nikkei hit an all-time high in 1989. I think it was 1989. And it did not recover for decades. And it's a fair point. The Japan's market had a bubble where stocks were trading at 100 times the price to earnings ratio. However, the US stock market has always been fundamentally different. The PE ratio of the S&P 500 ranges from 20 to 28 on average. You can't compare this to the Japanese market in the 1980s. Look, the stock market will crash. It always does. It's the nature of the game. But if history has proven anything, it's that people who stay invested always come out ahead. If you try to time the market, the odds are that you will miss the recovery. If you continue to invest when fear is at its highest, history suggests that you will be rewarded for that courage. If you panic and sell, you are turning a temporary loss into a permanent one. Some people ask, what if the market never recovers? My answer is simple. If that ever happens, money will be the least of your concerns. The entire economic system would be broken, and we would have far bigger problems to worry about. So stop overthinking, block out the noise, stick to the plan, stay invested, and remember, history is on your side.